Good afternoon, everybody. Welcome to today's Stock Market Brief show. We got through the Nvidia earnings, and as of right now, we're down a couple of percent in the aftermarket session with still a wide open range of risk coming down to and around the lower level about 119-ish to the upper level at about 144. This is going to create quite the day going into tomorrow's session. So I want to focus in on maybe a few signal charts that I see today, but dive into the expected moves for the index products. And I'm going to give you the list that I typically share with my Discord group. If you want to check that out, it's through Patreon. You sync your Discord up, you get all the benefits. It's a whopping $9 a month. In my opinion, it's well worth it. You get tradie ticks, you get the expected moves stuff that I post. I even include the scripts to, if you like these type of looks, I put together the script. I saw Brian Shannon do this and I liked it, so I just built it myself. So I have that in there. You have access to the community, obviously, the zones document, all kinds of cool stuff there. All right, everybody, welcome back. Let's start off with a snapshot of the market. So we're still trading within this range. Just a picture of ES. You can pull up SPX, look up SPY. SPY and SPX, they did hit new all-time highs. It's not shown here on the adjusted contracts, but ES has been in this trading range, and we're really kind of just doodling around the lower middle part, which do we still have the door open to this 5,900, maybe test these lows? Perhaps, but we're still above that rising 200-day. The market itself has been pricing in rate cuts more so as of recently, and as this is going on, we've seen TLT outperforming the SPY from a pretty wide margin over here. That's why we're seeing this line go down. This is a relative strength line between SPX, right, and TLT. So when this line goes down, it tells us that TLT is outperforming. And the question here is this more of a flight to safety, or is it just a little thing that's going on right now and we can move past it in a little bit? I guess we'll find that out more after the fact. But what I wanted to call out here is if you apply an RSI to this relative strength line, there's been a few times that we get down to this this 30 reading. We're not there quite yet, but when you see these sharp moves, it typically shows the market seeing some type of volatility, some type of fear, where TLT is used as kind of that safe haven, safe type of trade. The last time we seen the RSI down at these levels was August of last year. That's when I happened to be on vacation out there in Mexico, and the move was incredibly fast right at the start of the quarter, and it came down as far as its lower quarterly expected move within the first 10 days of the quarter. So pretty big move there. Over here was actually towards the bottom of the 2022 bear market. We still saw volatility going into 2023, and we saw about a 6% correction or so to start the year off before we started moving back up. I want to remind people too that this right now we're down about 4%, 5%-ish from the highs. It's very common to see this multiple times throughout many years. So for example, if you look at the year of 2024 right here on the SPX, so this is 2024, we saw this pullback, we saw this pullback, we saw this pullback, right? This was probably about a 10% correction. This was probably about a 6% or something like that. And then over here, right? So that was a couple of corrections there. 23 to 2024, right? We saw a 6% correction, 9% correction, something like that. In 2022, we saw multiple that was the bear market. So you can use that or not. But if you go back through history, you'll typically see multiple 5% to 10% corrections throughout any given year. And we're kind of going through one of those right now. Another interesting thing in the fixed income space, if you take a look at the 10-year 3-month yield curve, we did happen to reinvert or go uninvert, going back down below 0.0. So now we're negative 4 basis points on that Fed staple yield curve. We saw a couple of whipsaws over here and it came out. So this is not sustainable stuff. So I would imagine at some point we're going to see this back to uninvert once again. And I will analyze it once it does. You're seeing the 10-year yield really fall off here. And that has to do probably with the market pricing in these rate cuts. So the 10-year yield is falling off hard and fast. But take a look at oil too. Oil's moving with it. That correlation still holds. So if oil starts to bounce, maybe that brings up a little bit of bounce of the 10-year yield. But so far, this very sharp move to the downside, what is oil kind of sniffing out here in the economy? It's a very important economic commodity. And I'll tell you one thing, when you see huge moves to the upside, massive rate of change moves to the upside in oil, that is marked it's preceded every big economic recession that's happened. This is dating back since the oil embargo, and more recently, the big spike in oil. What happened thereafter? The more recent one was the Russian-Ukraine war going into 2022. So it's important to keep an eye on these commodities. If we take a look at volatility land, still there's nothing really screaming out fear right here and right now. Volatility has been rising, but if you look at the futures curve, it's not screaming fear right now, right? As of right now, right, the line goes to the bottom left to the top right. What does that mean? It means, yeah, we're all good here, and we see fear more into the future, right? We see rising volatility into the future. Where it gets crazy is if it's looking like this, right, where it's saying, the fear's here. We'll get out of this one day in the near future, though. So that is something to pay attention to, that I would imagine this can change if we start slipping off into no man's land or start breaking below that current range as it stands. If we take a look at back month versus front month volatility, we did reach down to this 1.0 yesterday intraday, but we still have not gotten down there from a closing basis, but we are nearing that point. So that still signals, hey, we could potentially get down there still. Bitcoin sold off a little bit more into the rising 200-day moving average. This right here was a pretty decent signal. The relative strength line between Bitcoin and S&P 500 crossing under that 50-period EMA, as well as our sailor to shift tool gave us a sell signal and a trigger right over here on this week. And we basically went sideways for a bit, down, sideways, up. And then we finally got that crack. So if this starts turning back around, that could be a potential positive sign. But ultimately, this signal and this trigger that I use, I look for the cross above it, the close above it to give more confirmation. But I definitely know people that front run the signal, front run the trigger, and play just from an absolute basis. So for example, if you were trying to look for a rising 200-day or that anchored VWAP that was in and around this area right here from that swing low in August, all good opportunities for layering into a potential position there. Let's take a look at market conditions. So first, let's look at net gamma. There's traders still reaching up to 6,200, and there's a lot of traders down here at about 5,900. So that's the range, right, that we're kind of deriving this range from, right? So we have about 6,200. That's up here on ES. It's similar on SPX, a little bit higher from these all-time highs. And then we have that 5,900 down here, and we've just been trading within this range. So really things could get crazy when? Well, if we start breaking from this level or breaking back up to the upside to reach that 6,200. So right now we are in negative gamma. This is where selling begets selling, buying begets buying. You get volatility that typically increases, right? So we've been seeing that. So as soon as we cross back above this gamma flip line, it's more likely to see volatility chill out and come off a bit. But it doesn't mean that we can't undercut and potentially start seeing a move higher. And when we see that move higher, volatility comes off then, but yet we could still be in that negative gamma. There's that 5,900 down here on SPX. I want to just mark out that there is a open gap down here in this area. So if we do undercut 5,900 and it flushes us, start to pay attention to this gap fill. If we do get and we break 5,900, I would imagine at that point, that could be what that fear that we see in the market where people start capitulating, this thing starts firing down below this. We maybe see the VIX futures curves change there too as well, but we're not there yet, all right? So we can create a bunch of narratives or so forth, or we can just be patient. If the market wants to do it, let the market do it. And then we ultimately wait then to see if the market can recoup itself by looking at the direction of this 5-day moving average from an intermarket, from an intraday time period, right? These are the 30-minute charts. And what do we see here? Well, we started getting the warning signs over here at the 20th and the 21st, and then it started curling down, started calculating this average down, and price has been below it. We've cracked underneath the year-to-date VWAPs on all these products, SPY, Q, IWN, semiconductors, biotech, and DIA. So everything right now is basically signaling, hey, this is a little bit more volatile environment, right? Under the flip line, below a declining 5-day moving average. Let the market prove itself before stepping in full force, because you don't need to catch the exact bottom, but it would be nice to know that you can catch part of the trend if we start moving to the upside. And in order to do that, you need to let the market kind of prove itself beforehand so you trade. You're not the one trying to prove yourself or trying to prove the market that you're correct. Let's look at the expected move. This is where it gets a little crazy today. The S&P 500 daily expected move going into tomorrow is $50. This is a very large implied move for a single trading session. And this is because, well, we're going to be walking into the day recovering from, obviously, We're not recovering the day morning after reporting Nvidia earnings. So we still have a wide open range of risk there. SPY is looking at about $6. Qs are looking at about $7.50. IWM is looking at about $2.59. You got your upper levels over here, lower level, and then you have your 2 standard deviation levels here too as well if the market really wants to get cooking. What's this look like on a chart? You can screenshot them, put the levels on your chart. We still have that declining 5-day moving average in purple. We're below the week-to-date VWAP. SPY just doodling around here. We saw a nice move intraday. It actually came right into the daily implied move for that day, for today. And then it started retracing from that level, a small recovery. Still have yet to tag the lower weekly implied move or the upper. This is pretty darn close, right? So whatever. It looked like it tagged it, but we'll just call a spade here. It didn't technically tag it. If we take a look at the Qs is just doodling around the lower weekly implied move here too as well. The more sideways we go in these products, the better. It shows that we're basing out, right? The 5-day moving average is going to start averaging down as it loses this prior data and starts gaining more data over here, right? And then it could start to flatten out and we could potentially find a pop through those levels and it could potentially see that trend change. It could also go sideways a bit more, go up, go down, and the 5-day moving average continues to decline, and then we get cracked and head lower. So this is all a potential possibility. The range for tomorrow on the Qs, if we start breaking the last year's closing price, take a look at the lower implied move down there. It's pretty large. Here's IWM over here. IWM has been just trading around its lower monthly expected move. We got down there on about the 24th. We bounced, we doodled, we came up, we doodled. So we're basically where the market priced in for the month, and we're nearing the month end here, still below these declining 5-day moving averages here on this product, and we're below the last year's closing price. I'd imagine at some point we can probably retest this last year's closing price and pay attention to that level here on IWM because it has memory, right? The price has memory to an extent. And if we get up to that closing price where we're positive on the year or flat on the year, those levels can act as potential resistance. Just like how we saw the Qs, it acted as support and support here. And if you date back and you look at this chart, it's been tagged multiple times. What do we have on deck? Well, going into the remainder of the week, we got some earnings, nothing too crazy on deck. Vistra, Dell, Fubo, Wolf, whatever. Nvidia was the big one. We got through it. Okay. And then as far as macro data goes, tomorrow we got some durable good numbers, GDP growth, more Fed speak, some auctions, more Fed speak on top of that. So nothing too crazy from what's on deck. And then on Friday, we get, once again, more macro data. That's all I got for you on today's episode, everybody. Hope it helps out. I'll see you on the next.